Hello traders, this is Frank Paul from Forex Mentor speaking with you on Saturday, February 23rd, 2013. Welcome to this latest weekend complimentary video presentation. We kind of switch back and forth each weekend from looking at the FXM Trend Trader methodology to this, our recently launched, or I should say relaunched, COT weekly service. And what I'd like to do today is to address the question of whether COT data can not only help you determine when a trend changes, let's say from short to long, but whether it can also help you as a position trader determine how long you should stay in that trend reading. So if that's a question that's on your mind, can COT data help you with that? The answer is yes. And I'm going to briefly illustrate how within this presentation. So I'd like to begin by presenting a fairly simple, unadorned chart view of Euro-US. And all we've got here are Heikin-Ashi bars, which are optional. I mean, you can use them or not as you wish. I kind of like them. I like to look at them at least. I could quickly click in and out of Heikin-Ashi bars in this particular charting platform I'm using. So if I'm ever a little bit confused as to whether a particular price bar is giving me a high or low of interest that's breaking support resistance, I just click out from Heikin-Ashi to regular candlesticks. Very simple thing to do. And then when I've answered my question, I go back in. Takes all of 2 seconds. So use whatever bar format you prefer. It's not particularly important here. But I've only got one indicator plotted. That's the 10-period exponential moving average. And what it helps me do is kind of determine the trend bar by bar. So if the latest 10-period EMA value on a daily bar close is higher than the day before with a positive slope, then we determine that the trend is up, which will be confirmed furthermore by the latest daily bar closing above that 10 EMA, because that drags that reading further still. It's only when you get a daily bar down through an upsloping 10 EMA that it changes the slope, tells you at least you have a correction, maybe a trend reversal, and vice versa. So I'm not trying to suggest that a 10 EMA is the be-all and end-all. It's just a handy confirmation of near-term trend. But the more important factor, of course, in this case will be what COT data has to say. So I've got two vertical lines drawn here, one for August 1st, and now that I look at it, I'm wondering why I'm not going back a couple days earlier. Anyway, late July, early August 2012. And another one drawn through December 24th, 2012. Okay, and I'll explain the significance of those junctures in just a minute. But what I'd also like to show you is the data table from the COT Market Watch service, and we have similar data tables, well, broken down into a tables page and a charts page, which you can download for each of 15 currency markets that we look at, all of the forex majors, the US dollar index, and implied COT positioning for a number of the more popular cross pairs derived from them, as well as 13 commodity futures. So you can download the tables, you can download the charts, you can do that in your choice of either Excel or PDF formats to take a closer look at the data as you wish. And so this is the table view for Euro, and as is true of all the currencies, we don't just show you the COT data specifically for the Euro in isolation. Our contention is that is a mistake. For any particular forex pair, you have to look at the implied positioning of the paired COT data for both sides. So for Euro-US, you can't just look at COT futures for the Euro. You have to combine that with COT futures for the dollar index, because it's quite possible that at any given time a long bias on one side could be totally offset by a long bias on the other, and vice versa, resulting in a non-extreme version for the pairing. So you have to look at both sides of the equation. That's only just basic common sense logic, but it's lost in a lot of the COT reporting that I've seen anyway for currencies. So we're going to scroll down here back in time, and I'm not sure if you can see it clearly, but the third column of the three here gives you the net positions for commercial traders, and we just label it spec, which is essentially everybody except the commercial traders. It's derived very simply by inverting the value for commercial traders. So if commercial traders are net short 28,836, that means all other sides of the market are net long, because for every commercial trader, long or short, there's an offsetting position among the non-commercial trading categories. Okay, so if it's minus 28,836, it's plus 28,836. Minus 4240, plus 4240. Very simple. We're looking for a very clear symmetrical reading here at an extreme. So if we go down here in time, all the way back to May 22nd, 2012, can't really highlight the row. Oh, there we go. You can see that the pairing of euro and dollar position gave a net long extreme reading starting May 22nd and continuing with only 3 weeks of interruption right through till July 24th, 2012. So basically mid-May to late July, there was still a downtrend unfolding, but this sort of week-over-week bullish information from the COT positioning told us, well, that trend is not going to last forever, and it's probably going to reverse sharply. So let's find the junctures May 15th to July 24th, which I don't think I properly labeled here. Oh yes, I did, right here. Almost. May 15th to July 24th. Okay, so as it turns out, it was a very long-winded bottoming process here, or it took quite a while for price to reach a bottom. Commercial traders grew increasingly net long here. There was a false bottom, and that became apparent when we saw some swing highs here. Here's one for June 18th. Here's another one for June 29th. And then price break down through a 10 EMA, which is still bearish, and commercial traders still going net long. So these top bottom reversal processes are never clean in the sense, well, I shouldn't say never, but usually they're not clean. This is a bit messier than usual, actually. It's not often this bad where you have to sort of wait and wait and wait for weeks at a time and still trade short with the trend reading, still wondering where the bottom is going to come to fruition. This is a messier scenario than usual, but it sometimes happens. However, into July 24th here, week over week, we see commercial traders going increasingly net long, increasingly bullish, so that suggests they're fading the move, and that furthermore suggests that if we're looking to trade short, we're trailing our stops as position traders a bit more aggressively and perhaps more frequently than usual, but totally expecting a bottom to kick in. And so the last COT bullish signal before the reversal happened here July 24th, and then fortunately not too long after that we had a couple of things. First of all, there was a pronounced swing point low for July 24th. That is a low preceded and followed by 2 higher lows on both sides. Then price closes above the 10 EMA on July 26th. As of July 27th, it would appear that we probably are starting now to head into that long anticipated reversal to the upside because of week over week bullish readings in the COT data. We were just looking for some kind of confirmation on the daily chart that that reversal has happened, and I would contend that we can at least take a stab at it starting the open for July 27th. And then it wasn't an easy trade for several days. There was a lot of choppiness, but eventually this thing got underway and continued, and then we hit a swing point high here, and then a couple days later we get a 10 EMA value crossing bearish. So then do you ask yourself, okay, has the trend changed here? Or perhaps over here, another swing point high. Okay, 10 EMA turning down. Well, what prevents you from calling a top fundamentally, even though you might have wanted to close out an open long position, but not specifically call a multi-month, multi-year downtrend, is the fact that COT data here was not registering an extreme bearish divergence. In other words, at what were sort of intermediate term tops, before we got what effectively was a retracement here against this larger leg. The fact that COT data was not suggesting a high-level trend reversal because there were no bearish divergence readings through here, October 2012. That told you that, yeah, we had a down move here, not a good place to look for a position trade long, but no specific reason to expect a multi-month or multi-year turn to the downside. Okay, and so when we have clues of a corrective bottom, the daily chart trend turning up again, and here's one, a swing point low for November 13th. Okay, price closing above the 10 EMA, the 10 EMA color coded now blue, which is bullish in my charting platform from red. That tells you that the only trend reversal we've seen anytime over the last 6 months, which was bullish back here in late July, is still intact. And you wouldn't look for an end to this higher level trend until you saw COT bearish signals kicking in, confirmed by a daily chart reversal. Now if I just pull the spreadsheet back up, we started getting bearish signals as early as right here, December 24th, and as it turns out, that was too early because, with the exception of only one weekly reading, January 8th, we kept seeing week over week bearish signals. But as that happens, week over week over week, you're saying to yourself, okay, this trend that has been up for a long time, okay, painting in red here, late December into February, that offsets this last batch of bullish readings May into July. So you're saying to yourself, any long position I have to manage very prudently, and I should be looking for clear enough evidence of a trend reversal. Now there's another thing we can do, just basically looking at market structure on the 4-hour and daily chart, specifically the 4-hour, because when I'm looking to call a top, I want to see a particular chart pattern I call a bearish reversal wave. We'll look at an example of that in just a minute. Not just a daily chart trend. But here we have, as was the case in the bottom, we had a fake top, because again, right here, December 24th, this was the first week that the COT data is saying, whoops, now commercial traders are no longer long, they're now at a net short position. And so we get a swing point high, price breaks down through the 10 EMA, and briefly it looks as though we're heading down. But then something happens, a swing point low for January 4th, and a couple days later price regroups and heads higher. Day after day, when we see that blue 10 EMA painting in, we're saying to ourselves, okay, well, that was a false top, we're still waiting for it. We're still waiting for a clear swing point high on the daily chart, and I'll just show you where that ended up forming right here. February 1st, a rejection wick high preceded and followed by 2 lower highs, and then in the aftermath, the 10 EMA turning bearish, which happened right here, February 8th, and thereafter it was a much cleaner down move. And we are in a downtrend, there's no doubt about it, into early February. I think Euro USD is heading down in a big way. I could show you the weekly chart continuation pattern, but I don't want to belabor the point too much. So we're looking for daily chart swing point reversals aligned with sustained EMA. Now you might be saying, okay, well, you know, it was wrong here, so what good is it? Well, the point is, if you can find a short entry, treat it like a day trade. You know, if price goes good to entry 20 to 30 pips, trail your stop to break even. And that was entirely doable through here into early January, even though price regrouped and headed higher, it was possible to at least trail a stop to break even. So you dust yourself off and say, okay, well, that wasn't it after all. You know, COT is excellent for directional bias. It doesn't necessarily give us a precisely timed entry signal. All you can do is try, manage your risk very prudently. Don't use ultra-wide stops with this, whatever you do. That's really foolhardy in my opinion. Use tight stops, just as tight as if you were looking for a day trade. And then finally, we do get the valid signal here. There was a confluence of resistance on the weekly chart right at this point here at about 13700 as well. So there's other things that we could have done, weekly chart analysis, monthly chart analysis, to help confirm that top. But that's what we're looking for from December 24th onwards. Now, if you get bearish COT signals, does that mean you can't trade long? No, trade with the trend as long as it's still intact. The point is, when that trend ends, it should turn over in a big way because the commercial traders are fading that move, and the first evidence that we get of a strong trend reversal, that's where we time it. So we time it again with a daily chart swing point high with the 10 EMA. I'm going to show you something else you can do here. When you have just an inkling that you might be at a top, a particular type of chart structure I really like to work with, I call a reversal wave. And right here, again, February 1st, we had a sharp wave down. That wave down took out the last low on the wave on the way up. So we were looking at a move like this. We had a low January 31st, but when price put in a wave down into February 5th, which broke that last low, that's a clue that the uptrend is no longer intact, because an uptrend is defined by a progression of higher highs and lows. But here we got a lower low, which breaks that projection. So price puts in a leg down into a swing point high, and then you're wondering, okay, is market flow turning over? Market flow being, again, a progression of lower lows and highs. You can, if you're gutsy, take the stance that yes, this swing point high on the 4-hour bar for 4 p.m. on the 5th is a corrective top, so we're looking to go short here. A more conservative stance, where it's confirmed unambiguously, is where price breaks that initial low, making a lower low. Because when we have that, it's the basic logic. There's a low, a lower high, lower lows. That is the progression we're looking for to confirm a downtrend. And then, you know, there were subsequent retracements. So it's not always the easiest thing in the world to just get in short any old place, and price action will oblige you right away. You still have to look to sell the rallies. Even as a position trader, you need to do that to avoid the necessity of ultra-wide stops. Okay, so there is no question by February 7th, on the 4-hour chart, we can confirm bearish market structure, and that lines up very well with a swing point high. Okay, again, February 7th right here. So we're calling a top, and that's incidentally where the 10 EMA turns down. No later than February 8th, we're saying that we've got reversal signals on the daily, reversal signals on the 4-hour, and we've also got COT bearish signals that we've been tracking for many weeks, which suggests that when we can do all of those things, call a top, that top should sustain a downtrend for a long time. And I would suggest to you that, again, the idea being using COT to guide you through that trend, we wouldn't assume that the trend is over, even if we get a big swing low, a big rally, you know. We won't assume that the fundamental downtrend is complete until and unless we get, well, I shouldn't say unless, it's just a matter of when, not if. But the next major COT reversal will be bullish, and that might not happen for many months into the future. But when we see that happening, we'll say, okay, the downtrend which started in early February is going to soon come to an end. The commercial traders are fading the downtrend, and we're going to look for a solid confluence of signals on the daily and or weekly charts to help us pick a bottom and assume that the trend is going to turn up again. But unless the COT data does that, you'll read every rally of daily chart significance as corrective in the downtrend. So the basic logic is COT bearish signals confirmed by chart technical analysis here. That signal, the bias is fundamentally intact until we get a reversal. COT bullish signals to offset the COT bearish signals that started the downtrend here in early February. Okay, so I hope that logic helps you in your understanding and interpretation of COT. And if you'd like some more information about what our service has to offer, I would like to invite you to come visit us at www.forexmentor.com/COT. Let me just type it for you. COT. And there we have a 21-minute long subscriber tour video. Just gives you a better idea as to what our service has to offer, how we approach COT data. And if you have any questions or comments on that or anything we do here, feel free to email me anytime via frank@forexmentor.com. Would love to hear from you, answer any questions you might have. And I definitely think that even if you're just a day trader, even if you're not a position trader, COT data can fundamentally help you determine trend. And I believe our resources are unparalleled in terms of doing that, with a specific focus on not just Forex pairs, but also 13 different supplemental markets we look at, which gives you a little bit more, a few more options to choose from if you want to look at commodities as well as forex. So thanks for joining us today. Have a great weekend, and we'll look forward to crossing paths with you hopefully very soon. Bye for now.